Welcome to AI on the Block, featuring Max Ledger and Allison Hashwell, presented by Evolve Blockchain.
All right, settle in, because we're taking a deep dive today into something genuinely significant. The Genius Act. This isn't just another piece of paper. It's landmark U.S. federal legislation, signed into law July 18th, 2025. And it's really set to fundamentally reshape how we think about and use stablecoins. We've got a pretty comprehensive overview of the Act as our source material today. It's packed with clear insights into its provisions and what kind of ripple effects we can expect. So our mission today is simple. Let's unpack what this means for you, the consumer, for the big banks, for the stablecoin issuers themselves, and really for the whole future of digital finance.
Yeah, and what's really striking here, I think, is that this isn't just some minor regulatory tweak, not at all. This is the U.S.'s first truly comprehensive federal framework specifically for stablecoins. It represents, a foundational shift. It's trying to strike that delicate balance, fostering continued innovation in the digital asset space, while also putting critical safeguards in place for the broader financial system. It's a huge moment.
Definitely. And to understand that impact, we first need to get clear on the basics. So let's start right at the beginning. What exactly does the Genius Act define as a payment stablecoin? And, why is that specific scope so crucial here?
Right. So our sources highlight that a payment stablecoin under this act is very precisely defined. It's one pegged one-to-one to the US dollar or maybe other approved highly liquid assets. And the importance of this specific definition, well, it really can't be overstated because it immediately comes with a massive legal clarity point. These payment stablecoins, they're explicitly excluded from being classified as securities or commodities.
Okay, wow, that's a huge distinction, isn't it? Why does that exclusion matter so much? Because for years, we've had this uncertainty around crypto assets. Is it a security like a stock or a commodity like gold?
Exactly. And the key insight here is that by giving stablecoins their own sort of distinct category, the act avoids trying to, shoehorn them into existing regulatory boxes that just weren't designed for them. I mean, think about it. If every stablecoin could potentially be deemed a security, it would trigger this host of complex, cumbersome disclosure and registration requirements that just don't fit a digital dollar meant for payments. So this exclusion, it removes a massive amount of that prior legal ambiguity that often stifled innovation, made it really difficult for projects to launch or get mainstream adoption. Basically clears a path for stablecoins to function as a pure medium of exchange, not some investment vehicle caught in a regulatory gray area.
Got it. So that defines what they are. Now, let's talk about trust. That's critical, right? When you're holding a digital dollar, you absolutely want to know it's actually worth what it says it is. And this act dives right into that. It demands really strict rules around how stablecoins are backed and how transparent those operations have to be. What exactly do those requirements look like?
Yeah, this is where the act really tries to build confidence. It mandates that stablecoins must be fully backed, one-to-one, backed by actual U.S. dollars or short-term U.S. treasuries.
Yeah.
So no fractional reserves, no exotic or potentially illiquid assets cluttering things up. We're talking the most stable, most liquid assets available. And beyond that, it enforces robust transparency measures, things like monthly public reserve disclosures, and regular independent audits too. This ensures you, the user, can actually verify that the backing is really there.
That sounds incredibly robust, really solid. But it also brings up an interesting point, especially for anyone used to traditional savings or even other crypto assets. Our sources indicate stablecoins under this act cannot pay interest or yield to holders. Why? Why that specific prohibition?
Yes. That's a critical trade-off, and it's absolutely by design. The act is prioritizing stability and simplicity above all else here. The core insight, really, is that the act deliberately strips stablecoins of any sort of investment-like characteristics. It aims to separate the idea of a stable digital currency from the potential for financial return. And this simplifies regulation immensely. It makes that one-to-one peg incredibly robust and just easy to understand. So while it means, yes, you won't earn interest, it reduces systemic risk. It prevents issuers from taking on riskier strategies just to generate yield, which, could compromise the peg itself. It's essentially saying, look, this is money for transactions, pure and simple. It's not an investment vehicle.
And that strategic choice, it definitely has significant implications. Because while it offers, like you said, unparalleled stability, it forces a question, doesn't it? Can a non-yielding asset truly compete for widespread adoption when, traditional finance offers savings accounts and DeFi offers all sorts of return opportunities? It's a fascinating challenge. Okay, so we've got these strict rules for backing, for transparency, all designed to build trust. But who's the referee? Who's making sure everyone actually plays by these rules? Like building a new skyscraper, you need an inspector, right? Well, for stablecoins, the Genius Act sets up this really interesting dual system for regulation.
Yeah, this dual system is quite unique, especially in finance regulation. For the larger issuers, and by larger we mean those with more than $10 billion in assets, they fall under direct federal oversight, specifically by the OCC. That's the Office of the Comptroller of the Currency. Now, for those less familiar, the OCC is the primary federal regulator for national banks and federal savings associations. So bringing them in for large stablecoin issuers, it really signals a move to treat these entities with the same kind of rigor as traditional financial institutions. Lends a huge amount of credibility.
Okay, that makes sense for the big players, but what about the smaller ones? Do they also have to deal with federal oversight?
Not necessarily, no. Smaller issuers have an option. They can opt for state regulation, but, and this is a big star, but only if their state standards are deemed substantially similar to the federal ones. And there's also a new body, Stablecoin Certification Review Committee. It's established specifically to ensure these consistent standards across the different regulators, whether they're federal or state.
Okay. So this federal-state tension, our sources identify that as both a potential strength, maybe offering flexibility, but also a challenge. What are some of the complexities or potential pitfalls of this dual approach?
Well, one of the key challenges is the potential for what's called regulatory arbitrage.
Yeah.
What we mean by that is, if state standards aren't perfectly aligned, or maybe enforcement differs, companies might try to choose to set up shop in states with slightly looser rules to avoid the stricter federal oversight. That could potentially undermine the overall safety framework.
Right, like finding the path of least resistance.
Exactly. For instance, a smaller issuer might choose to operate under a state license that maybe has less stringent capital requirements, or perhaps fewer audit mandates than the federal standard. Now, the Act tries to mitigate this with that substantially similar clause and the Certification Review Committee. But achieving true consistency across all 50 states, that's a monumental task. It's a really delicate balancing act, trying to foster innovation at a local level while maintaining a robust, unified regulatory perimeter nationwide. It's tricky.
Yeah, that sounds like a system that will definitely require some careful navigation to avoid, well, unintended consequences. So beyond all the rules and oversight structures, the Act really seems to zero in on protecting you, the consumer. What specific things does it put in place to ensure your peace of mind when you're holding these digital assets?
The consumer protections are quite robust, actually. They seem aimed at preventing the kind of problems we've unfortunately seen in the past in the crypto space. First off, if an issuer ever faces insolvency, stablecoin holders are prioritized. That means you're basically at the front of the line to get your funds back, which is a significant improvement over the past, right? Where in many crypto bankruptcies, ordinary users were often last in line if they got anything back at all.
So it's almost like a form of digital asset insurance, but not quite government-backed?
Precisely. It's not government-backed insurance, and in fact, there's a strict ban on any misleading claims suggesting that it is. No issuer can imply their stablecoin is federally insured or guarantees like a bank deposit. That clarity is really important to manage expectations. Additionally, issuers are mandated to comply with AML/KYC.
Anti-money laundering and know your customer, standard stuff for banks.
Exactly, to prevent illicit use of these assets. So they'll need to collect and verify user identities, just like traditional banks do.
Okay. And then there's a particularly interesting and maybe a potentially contentious provision we saw mentioned, the requirement for issuers to be able to freeze and seize tokens when they're legally ordered to. What are the implications there?
Yeah, that capability enabling the freezing and seizing of tokens under a legal order, it's a critical feature for law enforcement and national security, no question. It clearly signals an intent to integrate digital assets into traditional legal and criminal frameworks, meaning if there's a court order related to illicit activity, those specific tokens can potentially be locked down. However, it also presents a pretty significant technical hurdle for issuers. They need to implement these capabilities effectively, securely.
Powerful questions indeed. Lots for us all to think about as this new era of digital finance continues to unfold. Thank you so much for joining us on this deep dive into the Genius Act. We hope you feel much more well-informed and encouraged to continue exploring these incredibly important topics. Until next time.
Thanks for listening. Be sure to join Max and Allison next episode as they dig deeper into the different facets of Evolve blockchain. This has been AI on the Block.